Hi, welcome to this month's Chopping Wealth. I'm Brian Portnoy, founder and CEO of Shaping Wealth, and I'm really happy this month to have my friend, my guest, Greg Davies. Welcome, Greg.
Brian, thanks so much for having me.
Absolutely. All right, let's dive in. This is definitely going to be one of those conversations where by the end I'm going to say, "Oh, wait a minute, I had about 25 more questions." Let's start really at the beginning. Why don't you introduce yourself, and we'll go from there.
Okay, so I'm Greg Davies. I have, I guess what's most pertinent here is I've spent the last 2.5 decades specializing in applied behavioral finance, mostly in the areas of wealth management and financial advice, but more generally across the financial services industry generally. For what it's worth, grew up in South Africa, but have lived in the UK for the last 20 plus years. Absolutely passionate about all things behavioral, and the more multidisciplinary, the best. I started life as a traditional economist, focusing on micro and financial theory, but always had a really deep interest in philosophy. I did an undergrad major in philosophy as well. And that's the thing that ultimately pulled me towards the behavioral side, because in traditional economics, you've got all these little axioms of human behavior. This is how people are rational, point one, point two, point three, point four. And the whole edifice of microeconomics is built out of that. And yet none of those axioms are actually exhibited by people in the wild. And that sort of the philosophy of rationality and what it means and doesn't mean is the thing that drew me in. So I went back to university after working for a few years, did my PhD, focused specifically around behavioral finance in 2001, 2002, that sort of period, for about 3 or 4 years then. I set up in 2006 what was the banking world's very first behavioral finance team. And I led that team. That was at Barclays, based in the UK, but doing work all over the world. I led that team plus the quant team for Barclays Wealth for 10 years. And now I co-run Oxford Risk. We are a fintech firm that has been focused on applied behavioral finance from its very outset, but always focused on helping people, building software to help people make better financial decisions. So that's primarily what we focus on. And our client base is very largely financial advisors and I guess RIAs in the US context, and wealth managers.
Unbelievable. Two and a half decades. You could say quarter century.
Could do, yeah. Shortcut it. It, it's it seems depressingly long actually when you put it that way, and starts to age one.
Well, I started my investment career at Morningstar in 2000, so it has been a quarter century for me as well. So I think the starter pistol went off for us at the exact same time. I want to actually go back and go through some of those steps because we both know, and I guess most people dialing in for this conversation know that behavioral finance has sort of taken its journey through the world of investment management and wealth management. Those industries have transformed significantly, and the art and science of behavioral finance has sort of evolved along the way. So the PhD or the doctorate in behavioral finance, broadly defined, what was the initial curiosity that brought you into the space?
Well, I was originally going to do my PhD in the philosophy department, and I was going to focus it on studying the philosophy of rationality. I confess at that point I had had very little engagement with behavioral finance or behavioral economics at all, or even with psychology in any way whatsoever. But I started reading around the topic to pull together my PhD proposal, and picked up a number of books. One of them was Dick Thaler's Market Anomalies book. And a number of, one led to the other. And I started reading a lot of books in this field. And I thought, wow, I love the ivory tower of the philosophy world, but this is something that has one foot in that theory of academia and one foot in the practical realities of people's decision making. And I love that combination. I've always loved to have, a foot in the academic theory side, but actually be doing things practical at the same time. I also just love the multidisciplinary nature of it. So there was economics in there was maths in there was philosophy in there was finance in there, psychology, which I knew nothing about, but I thought, well, another string to the bow. So I was just drawn in by this feeling like it was at the epicenter of a whole bunch of stuff that I was interested in, both in theory and in practice.
Yeah, yeah, that's fascinating. Honestly, the path is very similar. The multidisciplinary element. My doctorate's in political science, but it was philosophy, it was law, it was sociology, it was economics at the University of Chicago, and that all kind of came together. And a few years down the road, behavioral finance, in some ways, is a window into our humanity. Happens to anchor on the money bit, but we know that the money bit triggers everything else. So it's pretty fascinating. I want to go ahead.
I was just going to say that it's funny to me, but there are a lot of good master's programs in applied behavioral science in the UK, and there's one at the LSE. And I've had so many friends of mine from prior areas of my life, people who had done something completely different, gone into marketing, gone into law, gone into whatever, and they all seem to have come around and converged on behavioral science as being something that stitches together lots of interests in their lives. And I find it fascinating that it doesn't actually matter which corner of the academic sphere you've come from. There's always something behavioral about it and something to draw you towards that when you're thinking about human decision making.
Yeah, yeah. Something I've been saying now for 2, 3 years in the context of what you and I do with applied behavioral finance is to sort of put aside or really criticize this idea that behavior is one dimension of financial planning or investment management, and instead suggest that it's not a tool, it's actually a form of gravity. We have physical gravity and we have gravity in the physical world, but you don't walk into a room and say, well, how's the gravity in here? You just accommodate it. Well, you don't enter any social relationship and say, how's let me get into the behavioral bit. No, behavior is actually a form of social gravity, always on, everywhere. And I think to your point, people show up in the space from every imaginable direction because it allows us to tackle the biggest questions as to just who we are as humans and what are we doing here and how do we navigate all of this mess. Um, so speaking of which, the Barclays unit, I'm really curious about that. That was sort of one of the original institutional attempts to take this field seriously. It's sort of I don't know other institutions that took it so seriously. What were the origins of the B5 team at Barclays, and how did that course through?
Oh, so I joined in late December 2006. And the origin for me was I got called by a headhunter about 6 months before who said, I've got this client who has a mad proposition. They want to start a behavioral finance team. And they really don't know what a behavioral finance team is going to do. But I don't know. So I always had this idea that there's a few senior executives there who'd read half of a Malcolm Gladwell book and decided that this was the new thing. And um, it was really an experiment, to be honest. What had happened at Barclays Wealth at the time is the CEO had managed to get the board of Barclays to sign off on a massive investment program to bring wealth management kicking and screaming into the 20th century, and try to put a lot more investment banking, I guess, efficiency under it and start to look for new ideas. And one of the new ideas that obviously floated to the top of the pile was this growing field of behavioral finance and behavioral economics. And I suspect the origin of that was the fact that in 2002, Daniel Kahneman won the Nobel Prize for behavioral economics. That was when I was doing my PhD. And I still think that Nobel Prize for Daniel Kahneman is the thing that turned my PhD into an interesting side event of stuff I was fascinated into the thing that actually built a career possibility. So Barclays was looking to try things that were new and stand out and differentiate. And we were one of the experiments that they put in motion there. And we hired, it was me plus two people right at the start. So, a small team. And we were, I'd worked previously as a consultant for several years in financial services with Oliver Wyman. So I was the one who kind of came in with prior commercial stuff, but we didn't really get given a very strong brief as to what we were to do. The brief that was there was your job is to take and bring ideas from these academic decision sciences and academic behavioral sciences, marry it together with your commercial ideas, and figure out how this can move the needle on the business. And so the first couple of years were really about experimentation. And the one thing that I remember deciding to do very early on was we cannot just turn this into a team that walks around the bank with PowerPoint decks and sits people into seminar rooms and tries to educate them about behavioral finance. We can do that, and we did do that, but that can't be all we did. And I had been working a little bit before on a lot of psychometric assessment work in a consulting project or two. And I thought, well, this is wealth management. They have clients that matter to them. Each client has a lot of wealth. The individual client matters. So why don't we try to help them systematize how we understand these people as individuals by building a psychometric profiling tool? And that's what we did. That was pretty much the first tool that we built. And 17 years later, 18 years later, what I'm doing at Oxford Risk now is still using version, I don't know, 7.3 or whatever of that initial thing, because fundamentally understanding people's financial personality is the route to personalizing how you communicate with them, how you engage with them, how you match them to things. But in the early Barclays days, I think the finance world liked the idea that we were building a tool rather than just conveying messages. And it had one really big advantage because we launched this tool in the UK in about early 2008. We sort of built it, we're pushing it out, and then we started pushing it out other places around the globe. So when the financial crisis hit in late 2008, we were thankfully in the middle of a big tech rollout, and we weren't on the list of people that could be easily fired very quickly. And 6 months later, you must have had this experience too, but the only area of economic theory that came out looking rosier than it had going into the financial crisis was behavioral economics. A lot of huge swathes of macro felt largely discredited. The micro stuff wasn't working. But my observation again and again and again is when times are good, people have a tendency to ignore behavioral science and emotions and the role of psychology. But whenever there's a crisis, whenever our emotional horizons narrow and we're worried about the world, then the role of psychology rises in prevalence. So actually having weathered that first 6 months because we were in the middle of a tech rollout, actually after that, the value of our behavioral team just went up and up and up for the next few years because people suddenly thought, hey, you know what, there is something to this behavioral stuff. It isn't all rational. I can see my clients making stupid, emotionally driven decisions, and I'd like to be able to do something about it.
Yeah. So what was then it's fascinating how that all came to bear, and we keep tracking each other. So I lived in London during the crisis from '07 to '09. So I was sitting there watching it all, but managing investor portfolios. So fascinating to say the least. And it was shortly thereafter that I had the behavioral light turn on in my life with Kahneman, Tversky, and social psychology and so forth. The transition you've been now at Oxford Risk for quite some time. Give me a short summary of what you do there in the role, and then I want to kind of dive deeply into questions about risk and investors and financial personality and such.
Yeah. So I think the thread that runs through everything from the start of Barclays to now is I've been trying to design and build things that help people make better financial decisions. And people has typically been retail investors or advisors, although done some work on professional investors. But things has changed. And at Oxford Risk, I'm doing that, but we are very intentionally a technology company. The biggest insight I think I came out of Barclays with is that it doesn't matter how good your behavioral ideas are. You can be bringing people absolutely wonderful ideas, but if you're layering extra knowledge requirements on top of their existing job, which is already hard and they've got a lot of moving parts, you've just made their lives more difficult. So 10 years of trying to do this at Barclays, and my observation was adoption is very difficult. There were always a small group of people who found it fascinating and did all the homework and really made it their own and made it work in their daily jobs. There were about 20 to 30% of people who just weren't interested at all because, oh, that's not how we do things here. Very, very conservative. And the people in the middle loved the stories, but really weren't about to engage with a lot of effort to make it happen. So I came to the conclusion, if behavioral finance is going to be truly effective in that it's being adopted and it's being scaled, it cannot stand without technology and it cannot stand without data science. And so at Oxford Risk, we build software. We build software to help make people make better financial decisions. I would split that into two broad camps. One is we build software for what in the UK we call suitability. It's all of the fact find, the client profiling. How do you measure someone and then crank the handle on all those numbers to identify the suitable risk level, to identify the appropriate asset allocation? So full end-to-end guidance system for advisors, if you like. What we're working on much, much more is more overtly behavioral. Suitability is about finding out what the right thing for someone is and then telling them what that right thing is. Now, unfortunately, telling someone the right thing for them to do is almost never enough to get them to actually do it because you have this intention action gap. You have behavioral and emotional barriers for people carrying through on what they intend to do, etc. So what we've been looking at or are looking at very heavily now is all around personalized client engagement and personalized communication. How do I, as an advisor, how do I equip an advisor to say the right thing to the right client at the right time in the right tone in order to help them take the next step that is in their interests? And mostly in their interests is quite simple. It means two things. It means helping them get invested, helping them all around the world. People are sitting on too much cash. Actually, less so in the States than almost everywhere else. You're ahead in that regard. But people sit on cash year after year after year. It costs them a huge amount, and keep them invested. When people are invested, they have emotional time horizons that are shorter than their financial time horizons. They get nervous, they get worried, they get anxious. If you can intervene with personalized messaging that is behaviorally driven, then you're going to help make people better investors. So that's the bulk of what we're focusing on now.
Yeah, it's fascinating. It's really fascinating. All right, let's kind of dive sort of into the deep end of the pool. And let me ask you just a broad question. What is risk?
Oh man, I've heard so many definitions of risk over the years. Um, the one I particularly like, and I can't remember how to attribute this exactly right, when I'll get the wording exactly wrong, but risk is simply the fact that more things can happen that will happen. The future is profoundly uncertain. We don't know what's going to happen. Many, many things can happen, and risk is that insight that there's a lot of things that can happen, and you have to protect. You have to accept that and be able to design your decisions to in the enlightened view that many, many different things can happen in the world. I will add something to that though, because in the narrow financial sense, risk is often identified very narrowly with a mathematical construct like a standard deviation. And one of the big issues with standard deviation is it treats risk as symmetrical. Any deviation from the expectation is deemed to be risky. And that is simply not true behaviorally. People do not think of, oh my God, there's a horrible chance that I might get 5% more than I expect next year, right? That's not risk. Risk is the chance of getting 5% less than you expect. So I think there's many different lenses you can view risk through, from the narrow sort of mathematical technical to the philosophical. But broadly speaking, it's just the chance that lots of things can happen, and the ones that will won't be the ones you necessarily expect.
So one thing that you do in your work that I think is really interesting, but see it around the industry, or the risk and behavior industry is to finally slice risk into different components: risk tolerance, risk capacity, risk need, and so forth. Can we go to that level? Because I want to build a bridge to the financial advisors listening to this conversation who are thinking about, hey, I just want to understand who my client is. And they might even ask, I want to understand who I am, and maybe what's the delta between who I am and who they are. You did a really fascinating study on noise that I want to get to in a little bit that speaks to that delta. But you bring to bear 7 different elements of risk, and we don't have to run the course through all of them. But let's go to the next level of nuance in terms of like how you are conceptualizing and measuring the different expressions of risk in the real world, and why this is meaningful for practitioners.
Yeah. So there, I think we're talking about less risk, which is what happens to me, and more about how I identify the level of risk that's appropriate for me to expose myself to. So we could think of that as the suitable risk level for me to take. And traditionally in financial advice in the regulation, this is thought of typically by regulators as having 2 key components. There's the risk I'm willing to take. That is a psychological variable. It's about me and my preferences. And then there's the risk that I am financially able to take, which is about my situation and my circumstances and my cash flow and my balance sheet, etc. So we could think of those as risk tolerance on the one hand and risk capacity on the other hand. And both of them are problematic in certain ways. So risk tolerance is often thought of as my risk appetite right now. But someone's risk appetite this morning is all over the place, right? It fluctuates. What I've had for breakfast, the context of what my portfolio has done yesterday, what my friends have told me about their opinions on the world economic and political situation over the weekend, all of these things momentarily will change my immediate tolerance for risk absolutely massively. And so there is a huge difference between measuring someone's long-term willingness to trade off risk and return over their total wealth. That's what we call risk tolerance as an input into identifying a suitable risk level. There's a world of difference between that and what someone says they're willing to, the risk someone says they're willing to take this morning. And the risk someone says they're willing to take this morning is an incredibly bad basis on which to design for them a portfolio that they're going to be holding for the next 5, 10, 15, or 20 years. So when I talk about risk tolerance there, I explicitly mean if you were being actually relatively non-behavioral, if you're being quite Spock-like, to pick the Star Trek character, what is your willingness to trade off the chance of something bad happening for the opportunity of something good happening? So you're trading off risk and return, and we have to anchor it on the long term, and we have to anchor it on your total wealth position for various technical reasons. So that gives me my star to steer by. I'm like, I'm traveling along. That's my destination. I'm aiming for that star. Risk capacity says, okay, well, I'm not investing my total wealth. I'm only investing a portion of my total wealth because actually, for a lot of my life, most of my wealth is actually in my human capital. It's in my future earnings potential. If I'm young, if I'm in my 20s and I've finished my education and I've landed a good job and I've got 40, 50 years of accumulation left ahead of me, the thought that if I just happen to have a low risk tolerance, that you put me in an 80% bond portfolio for the next 40 years is ludicrous, right? In order to understand how much risk I should take now, yes, I need to know my destination star. I also need to know where I'm starting from in order to point in the right direction. And that is risk capacity. That is my financial capacity to take risk. And it depends on my asset, my balance sheet, what assets I have, what liabilities I have, what income I have, what spending I have, when my retirement, all that stuff, right? So that we can boil into risk capacity. Then there is a third piece that is really important, which is I've kind of put on the side all of the behavioral stuff. I've said, don't let my short-term attitudes to risk influence my portfolio because I need to anchor on my long-term logical willingness to trade off risk and return. Now I need to put them back in because I need to realize these things do affect me, right? If I'm an anxious person, it doesn't matter what my star is. I'm at risk of jumping overboard along the journey. So this we can think of as my behavioral capacity. I know where I'm aiming, I know where I'm starting from, but I also need to know what I'm able to stomach along the way. And that we can think of as behavioral capacity, and we can measure it in various ways. But it's another parallel would be my risk capacity is my financial capacity is financial liquidity. Most people do not sell at the bottom of a crisis because they run out of financial liquidity. They sell because they run out of emotional liquidity. And so we need all of these three pieces working together: my risk tolerance, my risk capacity, and my behavioral capacity. And if I've understood all of those about someone, I'm really able to say this is what's right for you, not just for your financial needs, but for your emotional needs as well.
Is behavioral capacity the same as composure or risk composure?
Composure is a very good proxy for it. It's the primary proxy, and composure is a psychometric trait, at least in the way that we measure it, which is effectively your tendency towards emotional engagement with the journey or your emotional engagement with the here and now. If you are a low composure person, you are likely to always be on an emotional roller coaster, reacting to events. Someone with exactly the same risk capacity and exactly the same financial circumstances can have low composure or high composure. The high composure person is not emotionally affected by events as they happen nearly as much. Doesn't mean they're a brilliant investor. Sometimes they're too blasé, they're too laid back, they don't pay enough attention, they don't rebalance, all that stuff. So there's not necessarily a right or a wrong. It depends who you are and then how we design a solution that accepts who you are and makes the best of it.
To high composure could be you don't even know what's going on in the world. You're not paying attention. Ignorance is bliss, right?
Exactly, exactly.
I want to ground this in the practical workflow of the modern advisor. And let me throw a little kind of critical notes into the mix. So there is a wide range of opinions in the industry, and there are many firms that do risk tolerance questionnaires, some more sophisticated than others. Um, and some advisors find them quite helpful, many don't. You've been there since, the book of Genesis. You've seen this all evolve, right? So, what's been right, but also what's been wrong with the way these tools and perspectives have shown up on the desktop of that busy advisor who really doesn't want to get a PhD in behavioral finance. They just want a little bit of help in doing their job better. It's been a pretty mixed record over the hundreds of thousands of advisors, US, Canada, UK, Australia, and so forth, that are sort of playing around with these tools. In other words, what's gone right, but really what's gone wrong, because I listen to you and this is the world I'm in as well. This makes a lot of sense. This is very powerful. Why wouldn't we want to know these things? But then there is this gap between smart insight and science and practical reality.
Yeah. So let me start with, I think assessing risk tolerance objectively and independently is incredibly valuable, which you won't be surprised to hear me say. However, there are two big problems. And the first one is risk tolerance is a very, very small part of the overall solution. And the problem is it is easy to apply a number to. We'll get onto how accurate those numbers are in a second. But you know the old aphorism, it's what measured gets managed, right? So if you've got an easy number that says you are I don't know, a 1, 2, 3, 4, 5, 6, 7 on this scale, and by the way, you should be considering all this other stuff, the whole of your financial circumstances and your values and your behavioral capacity. But that stuff's already difficult. Then what you often find is people go, oh, well, the risk tolerance tool is the thing that matters more because it's the easy one to measure. And that's entirely wrong. I think it's a vital part of the solution, but it's actually quite a small part of the overall solution. And a lot of the way it has often been presented historically is this risk tolerance thing is the answer. This is your solution to finding the right risk level for clients. And you very quickly find these examples, like that 20-year-old I told you earlier, right? This person psychologically may actually just be really risk intolerant. They may be, let's say they're a 1 on a 1 to 7 scale, okay? But they're in their early 20s, they're earning well, they've got 50 years of saving left ahead of them. And if you argue that because this person is a 1 on risk tolerance, that the portfolio they should have is at the really low end of the spectrum, it's quite obviously bonkers, right? And so part of the problem is risk tolerance has for too long been treated as a sort of independent measure without enough consideration as to how it functions in the system of all the other things that we need to consider. And it's only when it works together with all those other things in the system in a coherent way that its power is actually valid and valuable. And we see that some advisory businesses go, well, risk tolerance tool says 3, therefore it must be a 3. And yes, we've sort of made some notes about the other stuff, but it just doesn't count that much. And then there are others who go, well, because it's obviously the answer is not a 3 for every person who comes out a 3 for their actual investable wealth. Well, that must mean the risk tolerance tool is bad. Well, no, it's not the tool that's bad. It's the way the tool is put in the context of everything else. So that's what we've been trying to do with our suitability tools at Oxford Risk is to build something that considers every piece in a consistent way. The other problem is a lot of the risk tolerance tools are bad. They're asking the wrong questions. Very often, they provide an answer to the question, how do you feel about risk this morning? Rather than the question that they should be asking is, what's your willingness to trade off risk and return in the long term over your total wealth? And if your risk tolerance score flops up and down week by week for the same person, depending on what happens in the markets and what happens in the political world, it's not measuring the right thing. It's complete bollocks, right? And so we see a lot of this, and we know that there are certain question types to which the answers are fundamentally unstable. If you ask people these questions one week versus the next week, they will give you a fundamentally different answer. And there's a whole class of tools out there which, in a view of trying to capture a little bit of, I don't know, academic or behavioral sophistication, they call themselves revealed preferences tools. And they put in front of people quite complex numerical trade-offs. If your portfolio, has a 10% chance of losing 13% over the next 6 weeks, would you choose that over one that has a 43% chance? People cannot answer these questions. And when they do, and they will answer them, they'll give an answer, but those answers are completely unstable. These tools are completely useless. And advisors looking at them go, I can see they're useless because people give the same person gives a different response this week and the next week. So bad tools is one problem. Good tools used ineffectively in the system is the second problem.
So why are the bad tools used? Because there seem to be a lot of them. Is it sort of something to do? It's something to talk about. Maybe it gives the imprimatur of sophistication and science and that we've got the right answer for you. It could be used for marketing, for lead generation, for conversational fluidity. Is that sort of how this has landed?
All of the above, I think, and I'd add something which is not inconsistent with what you've been saying, but having a simple numerical measure that I can follow is an easy crutch. It provides me with an excuse to not have to worry about too much of the nuance. And that's why I think, and it's slightly depressing to me, I think a lot of really good financial advisors hate risk tolerance tests because they want the nuance and they want the extra stuff. And the advisors who just want a shortcut to an answer are happy with the bad tools. And it's a pity because if the good advisors had a good tool in their hands that they could use in the right way, then I think they would see the value of it. But yeah, I think they're out there because people like to have a number and an answer and a box to tick.
What is the behavior gap? And does it exist? Is it real?
You need Carl on for this. I think here we go. Got a couple of his original artworks on that. So the behavior gap. Everyone's got a slightly different definition of this. I would say, to take a fairly broad definition, the behavior gap is the returns that people end up with in actuality relative to the returns that they would get if they just invested in something of the same risk level and left it alone. So it's almost the cost of your emotionally driven meddling in the portfolio. And some of it comes from timing decisions, tending to maybe take more risk, buy high, sell low, effectively. If I take more risk at the top and less risk at the bottom, I'm buying high and selling low. Some of it comes from action bias, over trading, over monitoring your portfolio. Some of it comes from chasing stories, past performance, familiar assets, home bias. All of these things are things that give us emotional comfort. We make these decisions because they're emotionally comfortable decisions to do. They are not financially sensible decisions to do. And the behavior gap is the gap between the, the returns I would get if I was acting like a completely cool, calm, and composed, hyperlogical person with my appropriate risk level versus how I actually do act. And I'd add one other nuance there. I tend to apply behavior gap to being that gap once I have invested, which means that there's another big cost out there, which is the cost of leaving money uninvested for too long. Now, you could argue that's part of the behavior gap or not. I tend to think of the behavior gap as the me versus the logical me who's not having emotional responses to the journey in what I invest in. And then separately, there's a question, am I costing myself because I'm too reluctant and I'm leaving too much money sitting in a savings account year after year doing nothing?
Okay. I mean, the headline numbers of the behavior gap are somewhat gaudy, and they paint the typical mom and pop investor as really quite foolish. You know, 2, 3, 4, 5+ % per year that you're leaving on the table because you're quote unquote irrational. And to me, irrational is an economist's fancy word for stupid. Um, and um, when you dig into the literature, you realize that it's a lot more nuanced in terms of, well, what exactly is, that gap from a quantitative point of view. But then I'd point to more anecdotally, or sort of call it, anecdata, I guess. Um, we see big swings in the market, and especially with the advent of index investing, you see data from places like Vanguard. Retail investors kind of stay the course a lot of the time. And so a lot of the fanfare around the behavior gap at times seems like an opportunity for advisors to step in and say, well, I'm going to be your behavioral coach, and you don't know what you're doing, but I do know what you're doing, as if the advisor isn't a human who doesn't also go through those same things. So where are we now in a more nuanced sense of, the extent to which the behavior gap actually exists in the world?
Yeah. I think your word gaudy is exactly right. I mean, some of those numbers are too big to be believed, at least on average. I mean, you can always point to an individual who did something really foolish, and yeah, right. But I would say our reading of decades of literature and industry studies, etc., we put the total gap in the realm of 3% per year on your total investable assets. Now, an important thing there is the majority of that actually doesn't come from the actions you take when you invest. So when you say retail investors can actually be pretty stable and sit the course, that actually, the mistakes you make once you invest, I think, are the smaller part of that 3%. Let's say it's 1% of that 3%. And that might be made up with some timing, some failing to rebalance, some lack of diversification, some, a lot of things pack into there. 2% of the 3% is failing to invest. It's leaving money on the side for far too long. Now, in these states, I think your numbers are better than here. But in the UK, there are, I don't know what the latest numbers are, but let's say 16 million households sitting on more than £10,000 of investable wealth in cash, doing nothing, and that happens year after year after year. The proportion of people who invest at all is pitifully small. Of the people who do invest, they're typically investing, I don't know, less than 40% of their investable wealth. So for me, you can still believe that investors who get invested can actually not be necessarily incurring themselves large gaps of money, but they're leaving masses on the table because they're too nervous to get invested in the first place. So I think the gap between perfect investing behavior and what people are getting is still quite large on average. I mean, 3% I'd say is a large number if it's per year across your total investable assets. But the larger part of that is from doing too little rather than doing too much, or investing too little.
So it's an important nuance, but it's also arguable. The phrase doing nothing, is the cash doing nothing? I could argue, one could argue it's doing a lot of things. Number one, it's probably earning a rate of return, probably a small rate of return. And, 5 years ago, cash paid zero. Now in the US, cash pays 4%. 4% is not nothing. Secondly, it could be providing a legitimate psychological use in terms of a sense of stability and comfort and optionality. Um, Leave it at that. Third, it could be a avoidance of friction. So yes, I could invest this money, but I'm going to need it at some point. And whether you think of it as an emergency fund or something that is, goal targeted or something else, I don't want to invest it because then if I need it, then and I will need it, then I've got to go to my online broker or tell my advisor to do all this stuff, and maybe there's tax consequences, maybe there's an illiquidity element to it. So two things. One, I really appreciate the distinction between within the 3%, the one versus the two. Because the 1% is really the behavior gap that we in the industry talk about. And that doesn't sound unreasonable. And some people stick through and some people make, poor decisions at a moment in time. And that makes a ton of sense. Whether or not the 2% counts as the behavior gap, I don't know if there's sort of that's almost a choice of definition as much as it is analytic. That's my immediate reaction to that.
So maybe you had three things there. I'll just maybe touch on them quickly, one each. So not doing nothing. Yes, interest rates go up, they go down. But I mean doing nothing here in terms of foregone outcomes. So excess returns, the money that you would earn over time for being invested in a moderate risk portfolio relative to the cash payment you'd get is still substantial, right? Through most of recorded history, you're looking at around excess returns of 4% to 5% per year. And if you're not invested, you're giving up on that. And it doesn't mean that you're not getting money from your savings account in certain interest environments, but you are giving up foregone returns. The third one I'll pick first because I think the main one is your second. The most important one is your second one. The third one was the friction point.
That's mine. That was a mine. I think that's a minor point.
It's a minor point, but it is absolutely vitally important that people have a liquid cash buffer. It's a safety net for getting invested in the first place. I would say the friction argument works well up to a point, but most people are sitting on far more cash than they would ever need for friction reasons. The middle one is, I think, the main one, which is what is the psychological benefits you get from sitting on cash? Now, you used earlier the word rational. I try and avoid the word rational in almost every sense whatsoever because
at Shaping Wealth, we are not allowed to use rational or irrational. We say normal, and if we want to sound fancy, we say adaptive.
Excellent. Because what economists mean by rational is such a narrow thing, and it just is so far from what people mean day to day. It's rife for confusion. Also, there is absolutely nothing irrational about wanting to sleep well at night because you feel comfortable in your situation rather than feeling uncomfortable in your situation. So it is perfectly rational to say, I'm intentionally going to give up upside or returns because I get a psychological or an emotional benefit from that. That's absolutely right. So we need to think of emotional comfort as part of the objective that we're trying to achieve from getting invested. It's not just a narrow financial return. The crucial question is, if we acknowledge that people need emotional comfort, the question that should follow from that, okay, is how do you get the emotional comfort you need in a cheap and efficient way rather than an unplanned, a knee-jerk, and an expensive way? And I would say of all the ways of getting emotional comfort, giving up 4 to 5% per year by sitting on cash is one of the most reliably expensive ways of buying emotional comfort. Now, it may be the only one you've got access to, but I would say communication, planning, understanding yourself, there's a whole raft of ways of getting emotional comfort in a much more effective way than just sitting with all your wealth in cash. And a term that I've been bandying around for ages is Financial theory says we need to optimize risk-adjusted returns. And it's a very narrow, and we've already touched on a bit, what do we mean by risk and why that can be all wrong. And it's not what people really want, I think. What people want is they want anxiety-adjusted returns. They want the best financial returns relative not to the risk they take, but relative to the stress, discomfort, and anxiety they're going to have to bear along that journey. And sure, some taking more risk does tend to come with more anxiety, but I can take risk and find ways of suppressing my anxiety in a whole lot of other ways. If I choose to solve my anxiety problem just by dialing down my risk to zero and putting everything in the mattress, it's just a very inefficient way of doing it. So if our goal is to help people invest well and comfortably, we still need to ask the question, is sitting in the cash the best way to do that, or are there better ways of us helping you to meet the confluence of those two needs?
The cost of emotional comfort. That I really like that phrase. I'm going to use it, and I'm going to cite you. Let's move to the advice side of the business. What's your, after a quarter century, or as you put it, 2.5 decades, what is the role of the modern advisor in best serving his or her clients?
So look, I think there is a baseline role of filling a knowledge gap, right? You partly go to an advisor because you hope that the person you're facing off on has studied the stuff and knows how to find the right answer better than you can. But as we've said before, finding people the right answer is not enough to get them to carry through on it. So the secondary value of the advisor, well, actually, maybe the more important value of the advisor is providing that emotional comfort. Advisors themselves, delegation and advice can itself be a source of emotional comfort that you can have regardless of what's in your portfolio. So the advisor who provides a sounding board, who knows the client well, who is able to understand where their emotional worries and barriers are, who can help to assuage that becomes fundamentally important. I also think that there's a trend beyond this, of course, as we went from the 60s where it was stockbrokers, I'm going to flog you a stock, to let's do a portfolio, let's adjust the risk return of the portfolio, let's put that in the context of your total wealth. Let's think about your cash flow planning, and then we've got financial planning thrown in. The onion has got broader and broader and broader over time of what advisors are supposed to do. And the layers that we're coming to now are very behavioral. They're, part of the value of the advisor is to find emotional comfort effectively. But it is also, I think, even to go beyond that and to help people understand what their objectives actually are. So to talk to clients, not just about financial returns and financial optimization and the comfort levels you need to engage with that, but what are you doing it for? What is your purpose in growing this wealth? How do you use your wealth better? And I know, there is a trend, certainly in the UK, and as I understand in the US as well, bridging advisor to life coach, if you like. And it's not a path everyone wants to go down, but certainly if as an advisor, you're not thinking about an ever bigger picture on behalf of your clients, then I think you're not pushing against the edges of your comfort zone in a way that you should.
Yeah, yeah, yeah. I've observed that relatively few, because this is what we do. We train financial life coaches. Relatively few advisors would explicitly say that I want to be a financial life coach. At the same time, most advisors will say, I'd like to use effective coaching techniques in my practice in order to serve my client. In some ways, it becomes a distinction without a difference, but the use of effective coaching practices can be an unlock to a much better relationship, which leads to my next question. There was a survey, and it was either Schwab or Morningstar, and it was some years ago, but it keeps getting bandied about, which is that advisors think of their number one role as being a behavioral coach. And then you survey the clients, and they rank behavioral coaching as like 14th out of 15th. So I guess, why and how do advisors see themselves in those roles? And you might have already answered that, so that could be the case. But then why the gap? If the data in those surveys, which tends not to be great data, but if those are even accurate.
All right, well, yeah, let's accept the data at face value. Why advisors? I think partly is that growing onion. There's a constant pressure to justify the cost of your advice and to demonstrate that you're adding more and more value at the edges and thinking more and more holistically. So I can see why advisors would want to make that claim. It also, takes you out of a very narrow, more mechanical role of identifying risk return combinations and asset allocations and makes you more, I guess, valuable in a human way to your clients. Why the gap? Most people, I think, do go to advisors primarily initially because they think that it's a complex world out there, the investing and finance world, and there are other people out there who know it better than they do. And so what they think they're paying for often is more of a knowledge gap, at least initially, I would have thought. And I think the industry somewhat perpetuates that feeling because there is a habit of using lots of numbers, using lots of jargon, trying to almost create the perception of an us versus them gap. There's all sorts of stuff that we know that you don't, and therefore you need. I mean, every profession does this, right? It's creating a moat between yourself and those that you're serving, so that they feel that they need to pay you because if they know everything that you do, then why would they need to pay you? But the other part there is I think it's valuable that the coaching and let's say the provision of emotional comfort isn't overt, right? It should be something I should be if I was an advisor, I should be able to provide my clients with emotional comfort without them thinking, oh, that's what I'm going to my advisor for. They're getting the emotional comfort because you know what you're doing, you're talking them through sensible decisions, you're preparing them for the ups and downs. You don't need to be telling them, I'm now giving you a piece of emotional comfort. Thank you. Could you pay me for that? So there's a sense in which I think that gap makes sense. The client is coming to you for something, but they're getting added benefits on the side. It's the same way as you go to a doctor, right? You're not paying for bedside manner, but goddamn, it's better if you get it. And so I think you're going to for medical advice, but you're going to step away from that relationship feeling that much better if that doctor has communicated with you well and has held your hand in an appropriate way through what you need to go through. So I don't think the gap is necessarily a problem.
Yeah. And by the way, absent that bedside manner, the care is worse. I think that's the more material fact, and I think it's empirically grounded when you look at research in the medical space. That extra level of care, quote unquote, bedside manner, means that clients are more willing to articulate their pain and concerns. They're more willing to take their medicines. You've got, a whole variety of positive behaviors that follow on that impact the more mechanical or expert-driven part of the care. Um, so, believe it or not, we're kind of wrapping up on the hour, and true to form, I have more questions than I'm possibly going to get to. So, you published a piece 2021 on the concept of noise, which is a book that Kahneman and some others wrote some years ago. And we don't have time to dig into the many interesting nuances there, but I walked away from that article as we talk about advice and the relationship between, advisors don't necessarily understand who their clients are. And in fact, are not just on the outside looking in to a subject behind a glass, but there's sort of an exchange of ideas and um, people get influenced along the way. One of the maybe the most important finding of that research, and I'm not sure if it's been updated, but regardless, is that if you give a large number of advisors the identical client profile, they are going to come up with a wide variety of assessments as to where that person sits on a risk tolerance or some sort of risk-oriented scale. And I just found it to be uh, one that was not surprising, but still very interesting. And two, I think a window into how much the personality of the advisor influences the nature of advice. The advisor is really not just a neutral judge or expert sitting on the outside looking in. Their values and identities and preferences are influencing what sort of advice the client gets. And that's fascinating. Could you say more about kind of what you found in this study and how you continue to think about it?
Yeah, so the study we had there was one that was published. We have also done the same study for a few brave wealth management firms who were willing to lift the carpet and see what was underneath, and we found exactly the same thing in those firms. And essentially, is that if you give the same client to 200 different advisors, the the outcome that they recommend, the level of risk they recommend, and by the way, risk tolerance we provided because we wanted to neutralize it. So we gave them the risk tolerance score going in. But we said, based on all of these things, you've now got their balance sheet, their cash flows, their retirement date, you've got their risk tolerance score, you've got all the information that you need to put together. You could drive an oil tanker between the extremes of this. I think every single client we showed to these hundreds of advisors, the recommended equity allocation varied between 10% and 100% for the same client with the same circumstances.
And was that the dependent variable? It was how much of an equity allocation they would recommend?
We used a number. That was one of them. That was, as a proxy for the risk level of the portfolio. We did a few more sort of more technical, sophisticated things, but that in the end was it. And it's interesting, when we looked at the statistics and the data, you can start to extract where is this coming from. So some of it, as you say, is because advisors come to it with their own preconceptions of, you see these out there, the person who thinks everything is stocks for the long run and every client, regardless of their circumstances, needs a 100% equity portfolio. And that exists. So there are people there. There are advisors who are just innately more conservative. I want to keep a big cash balance for, all sorts of reasons I've justified myself for. A big part of it was these advisors all had all the moving parts. They knew all the assets on the balance sheet, all the liabilities, they knew the cash flows. Most of them were, and we did ask them, most of them said, yes, I'm using all of it because I'm supposed to use all of it. The problem was, when you have humans putting together lots of information, lots of moving parts into one solution, they put them together in different ways. They give things different weights. For some, the cash flows are more important. For some, the liability of your mortgage is more important. So different advisors put them together in different ways. And that comes back to the why is risk tolerance often used badly, is there are advisors out there who you could see in the stats, the answer they gave to the clients was overwhelmingly weighting the risk tolerance score much higher than any of the financial circumstances stuff. And some of them were discounting the risk tolerance score entirely. And so this is one of the reasons why we think it is important that advisors use technology to do the complicated combination of moving quantitative parts in a consistent and efficient way. And I'll add something to that, though, because that sometimes then I get this reaction and people go, oh, well, you're trying to replace the advisor with a robot. And if I may use a medical analogy again, there is a difference between diagnosis and prescription. If you're going to the doctor and you want to be diagnosed, you want it to be accurate. You don't want the doctor making up their mind and, I don't know, staring at your aura from 4 feet away and deciding what your malady is. If you need the MRI scan, you want the MRI scan. If you need the blood test, you want the blood test. And almost the less human in that part of the process, the better, because you're going to have less noise and less bias. That, however, the answer from that diagnosis does not tell you what you need to do about it, because that depends on your values and where you are in your life. And am I the sort of person who can genuinely control this through exercising more and dieting more, or I'm the sort of person who I should just go for the operation? And I think that the noise we were seeing in the system was advisors often trying to do complex diagnosis that would be better done with technology and systems, leaving them free to focus on the prescription and the emotional comfort. And once you start muddling these things together and not using technology where technology is genuinely better than humans, that's when you get a lot of noise in the process and a lot of inconsistencies of outcomes.
I'm going to have you back because we've actually just sort of we've begun to walk through the door of the relationship between the technology and the human, the role of AI, personalization at scale, what we call humanization at scale. Um, Let me wrap up with one question, though, because you just published a really fascinating project. Give us a short advertisement, if you will, for the art of behavioral investing. I was a little bit involved with the project. I've seen it behind the scenes. It's really fascinating. This is something for friends and neighbors. It's a fabulous seminar, webinar that is available online for purchase. What's that project about? How do people find that for themselves or for their clients or their friends and neighbors? And then more broadly, how do people find you to keep up with your fascinating research?
Brilliant, and thank you for your contribution to that, which was most valuable. And it's we've got contributions from a lot of experts around the world, video contributions. So what the course is, I have spent almost all my life in big financial institutions talking to advisors, telling them how they should guide people on how to invest. And I just like many of us, I think, I have friends come to me and say, how should you get set about this? And I don't want to provide financial advice to friends. It's just a recipe for disaster. My daughter started getting interested in investing, and she said, where do I, what can I look at? And I thought, I've got 15 years of thinking about not what should you invest in, right? I'm not following markets here. It's not like buy oil or buy gold, but how should you start thinking about investing? What are the things that get in the way of you getting started? For a lot of people, they sit on cash just because they find the whole thing too daunting. So this course is aimed at everyday investors. It needs no prior, financial knowledge. It is 7 chapters, each of which has about 5 or 6 lessons in, which you can do in 15 or 20 minutes. So it's a whole course that takes you right from understanding yourself to the basics of how you set about investing and asset allocation, and tools, practical tools. We can think of them as decision prosthetics, the practical tools to buy the emotional comfort cheaply, or to manage your emotional state more effectively, all in one place. And I just thought, I've got all this stuff. I'd like to make it available to the world rather than writing it in tiny blogs and giving it to advisors. So the art of behavioral investing, done with a wonderful organization called 42 Courses. They specialize on online courses. These are really accessible and non-academic. And I say that because I struggled with that, because I always want to give more detail and more depth. They were brutal in stripping this away to what is the essence. So look at 42 Courses, the art of behavioral investing. If you want to find me, LinkedIn, Greg Davies on LinkedIn, and Oxford Risk. We publish blogs and articles pretty much every week. That's mostly focused on the financial advice industry and the stuff that we've been talking about rather than the everyday investor stuff. So there's a lot there. So it's www.oxfordrisk.com.
Fantastic. Greg Davies, thank you so much for coming on and chatting with me. And for everyone, this has been the latest episode of Chopping Wealth, one of the main features of our Compass content platform at Shaping Wealth. Until next time, take care.